Mass Mutual bought a boatload of Bitcoin, actually.
Oh, really?
Yeah, they were one of the early ones in that industry that bought some Bitcoin. I find like a company like Mass Mutual that's been through, I don't know, the World Wars, through the Great Depression. I mean, they've been around for 150 years or more.
Good track record.
I have some Mass Mutual policies and I'm not concerned right now. Money can be complicated. Let a nerd help you. We're here to demystify the complex nature of money by getting you answers from financial nerds and whiz kids. Welcome to Ask the Money Nerds, a weekly segment of the Wealth Labs podcast where we answer your most pressing money questions. Whole life. Is it a hole you throw your money into? Or that? Is it, you got to have the right health to get it? Maybe. What are your other alternatives? Have you heard about cash flow banking? Is it better just to go put your money in term and invest the difference? What should you be doing? Well, we've got 2 questions we're answering today. And just a reminder, go to askthemoneynerds.com, askthemoneynerds.com, if you have a question you'd like answered. All right, let's go, Stoba.
Yeah, let's do it. I want to know what is something new that you're into that you're enjoying these days?
Okay, I got a new guitar. And it's like a hybrid.
Grandfather?
No, I got that, but I got a hybrid one for the one-man show that we're working on. Mm-hmm. It's an acoustic electric hybrid, so it has a pickup and everything. Yep. And so I've been playing that a little bit. I've been doing a lot more stretching in the mornings. Okay. My buddy Ben Greenfield told me about these 5 Tibetan stretches, so I start the morning with that.
Should we have you demonstrate?
No. They're not that hard. I mean, one is it's like everybody knows. It's like I go from downward dog, then a slow kind of reverse push-up, then into cobra, do 10 of those, and, do the rebounder for a few minutes. And so I've been starting the day that way, but I've been doing a lot of comedy lately. Ton of comedy.
Yeah.
Doing something tonight.
You get to hear it. Tuesday, Thursday.
Again. Yeah, every Tuesday, Thursday, and then more. So
yeah. I think one of the things that I've been enjoying this winter is snowshoeing.
Yeah.
Who got
you some snowshoes?
You got me
That's
snowshoes for my birthday, and I've been enjoying them. And what's another thing? Oh, I found myself nerding out on a neurobiology podcast. Have you heard of Huberman Lab?
Nope.
Oh, I started listening to him on a podcast, and then I realized, I'm like, this scientist is very articulate and it's easy to understand what he's saying. And he's just so fascinating. Cool. So I spent a Friday night just totally geeking out on like 2-hour episodes.
What are you doing Friday? I'm going to be geeking out on a podcast. You're our ideal listener. We need someone that's just like, oh yeah.
Oh, should we geek out on whole life insurance policies?
Let's do it.
We have 2 questions we're going to combine in for today's episode, Dana's question and Barry's question. And we're going to start with Dana. And she says, so I got my first whole life insurance policy and I'm pretty excited. I'm 26, nice. So I basically just joined the workforce. So I have some money saved, especially since I live at home rent free. Awesome. Nice. I decided to put some of my money in a whole life policy because I like how it's out of the banking system, which is safer in the case of banks or economies collapsing, as well as protections against bankruptcy or collections. Mm-hmm. However, I'm concerned about how my company, Mass Mutual's biggest assets are bonds. As far as I understand, interest rates are really low, and if they go higher, which they most likely will, I know bond values decrease, which sucks because I'm entering adulthood at the time of most likely high interest rates, but it is what it is. Are there other ways whole life insurance companies combat or offset potential losses like these to reduce loss of profit?
Yeah, she makes a good point here, because when you have a bond, let's say that a bond is essentially a debt instrument where you've lent money to the government or to a corporation, and they give you an interest rate on that. Now, if you were to sell that at a time where interest rates go up, well, you'd have to sell it at a lower price because someone can go get a new bond with a higher interest rate. And that's what she's talking about. It's called capital depreciation, essentially.
Okay.
A lot of the insurance companies, you have to look at their portfolio. Are they trading the bonds very often? Or do they have longer term bonds because they have large sums of money? It's when you're in a bond fund that is especially concerning. A bond fund is like a mutual fund where you have a lot of different bonds and they're trading them on a regular basis. As they trade those, well, you could have to trade and, sell it at a loss. But this is a strategy a lot of people use. It's called a bond ladder. So a bond ladder says, we're going to have some really short-term bonds. some medium term and long term. So long term, you know, going, okay, we're going to have these for over 10 years. Short term might be, you know, you might even be using treasury or T-bills or T-notes. And they're going to be really short term, not going to pay a whole lot of interest. And medium term bonds, you know, you're still, because you're lending the money for a shorter period of time, you might not be getting as high of an interest rate. So that's one of the ways that they kind of combat the fluctuating interest rates, is with these kind of bond ladder structures. Okay. And one of the things that happen with some of these major insurance companies is they got to buy longer term bonds that were non-callable. Non-callable means that even when interest rates change, a lot of bonds that people have, the company can go, oh, we're going to buy that bond back because we can get that money cheaper now, right? So those non-callable bonds are really helpful. But they're also, when you borrow from your policy, you're actually paying an interest rate to the insurance company for using their money. That's one way that they help with their portfolio. Mass Mutual bought a boatload of Bitcoin, actually.
Oh, really?
Yeah, they were one of the early ones in that industry that bought some Bitcoin. So, you know, and they also do collateralized debt obligations, which there's definitely some potential risk with those, right? So it's basically, you know, there used to be like mortgage-backed securities. You probably heard about those, because those in 2008.
Yeah.
You saw like people were, like these companies were lending money and they were buying paper or buying these portfolios of loans. And a lot of those loans got defaulted on. So yes, these different things have risk, but there are more restrictions and requirements on insurance companies. And there's also people that pay for term insurance, which only pay out 1.1% of the time. And that fuels some of the dividends as well. So they've got pretty substantial reserves. They're doing bond ladders, not just bond funds, because they're buying them individually versus as a fund that's being traded. Do they face some risks? Definitely. But also, I find like a company like Mass Mutual that's been through, I don't know, the World Wars, through the Great Depression. I mean, they've been around for 150 years or more.
Good track record.
And you know, they're investing in a fairly conservative way. So it's something to be aware of, and it's to understand these collateralized debt obligations and different things like that. Like, what are the potential defaults that could happen there, and what percentage of the portfolio is in that? But I have some Mass Mutual policies, and I'm not concerned right now. Okay.
So as a policy holder of a whole life insurance policy, how can you go about, you know, learning about what your company, in this case it's Mass Mutual, is investing in? Like, you get annual reports, you can look things up, you can ask your agent. Are they pretty transparent about?
I mean, it's not like you know exactly what's being held, but you know the percentages of what's being held and what types of assets are being held as an overall, like, and they'll give you a pie chart and kind of show that sliver. So
okay. Yep. Anything that a person should look out for when they're reviewing that?
I mean, some companies have a little bit heavier weighting in the stock market, but it's still restricted to how much they can actually do based upon insurance regulation. Okay. So, you know, I think you can look at like, what are their ratings overall are somewhat helpful. What are their cash reserves are somewhat helpful. What percentages are they, you know, in more volatile or variable investments, which, you know, Mass Mutual doesn't have a lot of that. So that's also helpful. Okay.
Do you have any other companies that, you know, viewers and listeners could look into if they're researching getting a policy?
The policies that I have are with Penn Mutual. They're with Mass Mutual, as we mentioned, Guardian, Emeritus, which I'm not a huge fan of, One America. Do we have any others? Those are the main ones at this point. Cashflowbanking.com, they can actually secure an appointment, and those guys can represent a bunch of different companies. They're not beholden just to one company, which is kind of helpful.
Yeah. So the other question that we have is Barry. And so Dana's pretty young. She started at 26. Barry's a little bit older. He's going through bypass surgery soon and wants to know what impact that will have on his ability to purchase a whole life insurance policy. So do you just want to speak to and elaborate on the issues that might limit a person from receiving a whole life policy and getting approved for it?
Health concerns are definitely one of those factors. And some companies have a little bit looser guidelines on certain areas and stricter on others. Okay. Once you get above what's called the threshold where there's reinsurance, it's all kind of the same. You know, some companies after $1 million or $5 million or $10 million go to reinsurance, and it is a little bit harder. It is a little bit more strict because it's now in a general pool of risk that everybody's facing.
What do you mean by reinsurance?
Reinsurance is like an insurance company doesn't want to have one person die and be like, oh, we had $100 million policy on that one person and our company took $100 million hit. So they might say, after $5 million, we actually go and take the risk to these other insurers called reinsurers, and then they pool that risk amongst a bunch of insurers.
Oh, I see.
So it's just a mitigation strategy. So there are ways that you could go and apply for insurance or inquire about insurance, and even companies will do this and say, if this surgery is happening or this is going on, what would the potential rating be? What would need to happen so that you don't get a formal denial? And they'll kind of give you a look, and they could look at different companies to see which one might, be willing to do that. And there might just be a moratorium where they're not going to do anything. There's sometimes where people get cancer, they can't get insurance, but after it's been in remission for a certain period of time, then they get insurance. Sometimes that insurance is rated, right? And usually the more insurance you get, as I said, the harder it is to get those coverages.
Okay. So if a person is seeking to buy a whole life insurance policy and they have a health concern or there is a surgery that's coming up in their life, they can inquire about the potential impact before they get a formal denial, because I imagine a formal denial is something that's going to impact the person.
Yeah, because when you go apply, they're going to see that.
Yeah.
For a certain period of time, there's certain, 5-year or 10-year things that are going to show up.
So it's a significant amount of time. So if someone gets a formal denial with one company, does that show itself to another company, right?
Because you have to say, they ask.
Yeah.
Right? And if you lie and they catch you, there's 2 years contestability.
Ooh.
Where if something happens, they don't have to honor the claim. They just refund the premium.
Yeah.
So after the 2 years, I guess if you got away with it, you got away with it. But there's questions that are being asked. You're signing release forms. Like on the medical side, you sign a HIPAA form, then they can go and look at your medical history. They could find out, if you didn't tell them about some issue or whatever by researching. I mean, these companies are fairly good at all that kind of stuff.
Yeah, I imagine they're doing everything to mitigate their risk and liability.
So we figured out a couple of insurance companies to look at, a little bit about how the insurance companies manage their portfolios, and what happens if you have a health concern. You can also look at policies on a spouse or on children if you have children. My preference is definitely get it on the breadwinner first, and then look at the other ones secondarily. But this is why it might make sense to get policies on kids, because what if they have a health issue in the future? You kind of secure their insurability by getting it earlier. And if you get term insurance when you can't afford an overfunded cash value policy, those are policies that can be converted in the future regardless of your health. So just make sure it's with the right company. I say cashflowbanking.com. I obviously endorse and license and don't have any ownership in that company, but I actually own the site cashflowbanking.com for a long time and was part of creating that to a degree. So anyway, turn your thoughts into profits and go out there and build the life you love. Want to continue the path to be a better investor? Make sure that you're not losing money and taking too much risk? Well, click here and learn about strengths vesting.